Hello, my name is Grant Joyner. I am a certified financial planner and enrolled agent, and I am the founder of Vineyard Wealth Group, as in Martha's Vineyard, which is the island in which I live and raise my children and my family. And it's also the island that I grew up on. And I have been a financial advisor for close to 20 years. And I'll tell you that giving advice here is unlike giving advice anywhere else that I've ever lived, because the island is unique in a million different ways. And whether you live here year round, come in the summer, or just own property here, you probably have come across some of those nuanced differences. And so that is what we're going to be talking about today, which is a guide to financial planning on the island. Because again, it is unique here. And so let's dive into it. Pretty quick agenda here, but we're going to be talking about what makes it different, retirement planning for seasonal business owners, or even just income that is not always coming in at the exact time, and the real cost of home ownership, and then the Massachusetts tax cliff, which if you own a home here, you're almost certainly in a situation where you might be subject to estate tax on the Massachusetts level. And we'll talk about options to consider avoiding that, or at least just avoiding probate altogether. All right, so what makes financial planning different here? There is a massive seasonal swing, right? Anybody who lives here, who has visited here, knows that in the summer, it's incredibly busy. Right now, it is early August and the island is bustling. We're going to have the fair coming up. We're going to have Elimination Night. We're going to have a million things going on, and it's about to get really, really busy here. And then fast forward 5-6 months, it's going to feel pretty dead. The island does have a year-round economy, more so than even when I was a kid growing up here, but obviously massive seasonal swings for people. And, a lot of income is derived for a lot of islanders during those summer months. Property heavy net worth, right? So if you've bought a property on the island, whether you bought it recently or later, it's probably a big part of your net worth. For a lot of folks that live on the island, the majority of their wealth is concentrated in their house, right? Because they bought it years ago, and we've seen, the island market sort of do this. It rarely goes down, but it sort of can go up and plateau and then go up again. And we obviously had a big spike coming out of COVID. And then just really that seasonal income, which is the same kind of piece of this, where it's, because there's a seasonal economy here, the seasons with the weather and seasons with tourism, and certainly seasonal income. And so we're going to talk through kind of how we see that, how we work with people on that, and retirement planning for seasonal business owners, right? So I'm just throwing this all up on the screen, right? So when your income is not consistent, it can make it incredibly hard to budget. And for a lot of folks, when we sit down with them, if they are somebody that has income that fluctuates, whether they're working in the trades or real estate or tourism, what we talk about is different options for them that don't require money to be invested right away, right? Options that once you kind of know what your year looks like from a tax perspective, that you have the opportunity to, after the fact, start saving for retirement or other items. This is largely for retirement that we're talking about. But each one of these has a different deadline, right? So you have, 401ks, traditional IRAs, SEP IRAs, right? So some of these are employer-sponsored plans, or if you're a self-employed business owner, you have these at your tools, and others anybody can use, but they all have different dates around when you need to contribute them. Typically 401k, you got to do that by the end of the year. Traditional and Roth IRA up until the tax filing deadline. And then if you are using a SEP IRA, it's up until your tax filing deadline. And so with extension, that can go till October 15th, right? But each one of these gives you an opportunity to potentially lower your tax bill and save for retirement. Or in the case of a Roth, you're putting that money away after tax, but it's not something that you have to do ahead of time, right? Because it's not as easy to basically just say, I'm going to take money out of every paycheck when you don't know what that paycheck is going to look like over the winter months, right? And you don't know what your cash flow is going to look like, right? So oftentimes when we work with people, we're helping them pick out the plan that makes most sense for their tax situation, but also for their cash flow situation. We work on budgeting and so on and so forth, right? How to plan around the costs of property, right? So when you look at property, whether you're buying or selling, you're dealing with a lot of different things here on the island because of the cost of real estate, and then some of the uniqueness with land bank fees, right? So if you're buying a home, you're almost certainly going to have the land bank fee. If you're selling a home, if it's your primary residence, you might get a home sale exclusion. So that's $250,000 for single, $500,000 for joint. That's how much of your gain would be excluded. But if it's a secondary home, you're going to be paying capital gains and potential depreciation recapture. But capital gains are typically 0%, 15%, or 20%, with a 3.8% net investment surtax if you cross over certain income tax thresholds, right? So these things can start to add up really quick. If you're selling a home and you have a capital gain and maybe you're at 20%, 5% Massachusetts state capital gains tax, 3.8% surtax. And if you sell a big enough home, now with the Massachusetts millionaire's tax, you can take it from a 5% tax all the way up to a 9% tax on all of your income. So there's some thresholds that you want to be really careful of, right? There are different things that you can do depending on your situation. And we work with people, if you're buying your first home through the land bank, or you have the land bank fee. If it's your first time purchase, you might be able to avoid that 2%. If you have a purely rental property and you wanted to sell it and invest it into another rental property, there's 1031 exchanges. If you have a house that is not your primary residence, but you wanted to make it your primary residence, you might be able to get, if you lived in it for a couple years or beyond, you might be able to get some of that home sale exclusion. And then really, when you buy a house, you have your basis in it. So if you bought a house for $500,000, that's your basis. If you do repairs, those don't increase your basis, but capital improvements do. So you add a garage, you add an extension on. Those costs are increasing your basis so that when you sell the home, let's say you put a $100,000 capital improvement and then you sold the home for $1.1 million. If you held it jointly with your spouse and you got a $500,000 home sale exclusion, you'd get 1.1 minus 600,000, that full gain would be excluded. So this is something that we work with a lot of people on, is helping them understand what their basis is and what their options are with property. And as properties have gone up, so have property taxes. But one of the things that we're starting to see on the island, because of the increase in property taxes for a variety of reasons, there's a lot of capital improvement projects that have been put off. We saw this with the Vineyard Haven School that went in and the raise of that. We'll see this with the high school. As that gets built out, the property taxes go up. I live in West Tisbury, the West Tisbury School, beautiful school, but it's the same exact school that I went to and my kids are now going to it. Eventually, that's going to need to be renovated and potentially rebuilt. But towns have started to put in the residential tax exemptions, which means that part of your property tax might go down if this is your primary residence. Right now, it's in West Tisbury, Tisbury and Oak Bluffs, but there's been talk of all towns adopting this. And one of the things I hear, not to say I have, I'm not going to provide opinions on the residential tax exemption in this forum, but for a lot of people, Boston included, for people that have second homes here, there's this sort of concept, oh, well, they don't use all the services here, and that's understandable. But in cities like Boston, Boston has its own residential tax exemption. So if they have a primary home in Boston and a second home here in Massachusetts or in Martha's Vineyard, they might not be getting the residential tax exemption on their home here, but they would get it in Boston, right? But what this does, it's not 30% off of your taxes in this case. What it does is it takes 30% off of the average home price or median home price. So in something like that, in a case, let's say you lived in West Tisbury and you had a home that was worth about 1.2 million and you did get the residential tax exemption, you'd get about $500,000 off that. So you'd be taxed on the home as if it was about a $700,000 home, right? But it's something that you have to make sure that you have filed for it appropriately and that you get it. And there's some other exclusions or reduction in taxes if you have low income in other items in towns that are town specific that we help work people through. So the other piece, if you own real estate on Martha's Vineyard, it's really easy for you to go over the Massachusetts estate tax exemption. Federally, it's $15 million for a person. So that means that during your life, in and passing, you can give away $15 million to somebody else without paying any federal estate tax. Massachusetts is a $2 million threshold. And that $2 million threshold, you can see the median home price on the island is $1.7 million. So if you own a house and then any other assets, it's really easy to get over that Massachusetts estate tax cliff. So what can you do to avoid that? Well, there's a lot of different tools at your disposal depending on kind of your situation, whether it's gifting to children, charitable gifting, using annual exclusions, or even using living trusts and marital trusts to capture that exclusion for a couple. Let's say you had a couple that had a $4 million net worth. There are ways that you can capture it. So the first to pass would capture their $2 million exclusion while still allowing their spouse to utilize the income from their assets. But then those assets would pass outside of their state. It's a little nuanced. I'm not going to get into all the details on this video, but I will in later videos dive into that deeper. But the point being that is, if you do own a home on Martha's Vineyard, whether it's a primary or secondary residence, it's likely putting you into a Massachusetts estate tax zone that you would want to plan around to make sure that you either try to avoid it outright or that you have a plan for how that's going to be paid in the future. Because absent that, if somebody were to inherit a big property and they didn't have cash flow to pay for it, it's typically going to lead to them selling it or borrowing against it. And those are things that you can plan for ahead of time, right? I say Massachusetts, phenomenal state to live in, love to live here. Bad state to die in from an estate tax perspective. And so with all of this stuff, we recognize that living on the island is unique. We are Vineyard Wealth Group. We set up this firm uniquely for islanders, right? So it doesn't mean that we don't work with people. We work with people that have no relation to the island, people that live off island, and a lot of people that have secondary homes here. But we recognize that for islanders specifically, there's a lot of nuance to their specific situations, whether it be cash flow, tax planning, thinking about buying or selling real estate. There are specific things that you're probably going to deal with once or twice in your life, and we're dealing with them once or twice a day. So if you need help with any of this, whether it's just general retirement planning, planning around taxes, any of these items, we'd encourage you to reach out. Whether you give us a call at 508-696-2000, follow our Instagram, Vineyard Wealth Group, check out our YouTube channel. You're watching this on YouTube now, so hopefully you like this video and subscribe to it, or just book a complimentary consultation where we'll give you a second set of eyes on anything that you're doing and tell you exactly what we see at no charge. We'd love to hear from you on these topics, and stay tuned. We're going to be diving deeper into a lot of these in future videos and future blogs. But thank you for watching.